In January 2026, three South American nations signed an agreement that immediately disrupted global electric vehicle markets. Battery material costs jumped 22% within weeks. To understand why, we need to talk about lithium and who controls it. Lithium is the critical element in EV batteries. Unlike oil, which powers existing infrastructure, lithium enables the transition away from it. When three countries that sit on more than half the world's supply decide to coordinate, markets react fast. The Santiago Declaration, signed by Argentina, Bolivia, and Chile, establishes what analysts are calling a lithium cartel. Together, these nations control approximately 58% of global lithium reserves, concentrated in South America's lithium triangle. The agreement introduces two key mechanisms: coordinated pricing floors and supply controls. Nah, this isn't theoretical. Within weeks of the declaration, lithium carbonate prices rose sharply, flowing directly into battery production costs. The comparison to OPEC is instructive but imperfect. OPEC members control oil extraction and export volumes. The Santiago Declaration members are attempting similar coordination over lithium, though the market is smaller and more concentrated. The difference is that lithium supply chains were already tight. This agreement removes whatever flexibility remained. Price floors work by preventing competition from driving prices below a set level. When Argentina, Bolivia, and Chile agree not to undercut each other, buyers lose negotiating power. Supply controls limit how much lithium enters the market, regardless of demand. Only battery manufacturers, the companies that turn raw lithium into cells, absorb the first shock. But these costs don't stop there. They flow to automakers, who are now recalculating margins on every EV model. Tesla, BYD, and Ford have different levels of exposure depending on their supplier contracts and vertical integration, but none are insulated. The 22% increase in battery material costs translates roughly to a 10 to 15% increase in total battery pack costs, which represent about 40% of an EV's price. For decades, lithium-rich nations exported raw materials, while other countries captured the value from refining and manufacturing. The Santiago Declaration represents a strategic shift. Argentina, Bolivia, and Chile are asserting control over their primary economic leverage: access to the resource itself. By coordinating supply and pricing, they're attempting to capture more value without necessarily building the entire downstream supply chain. This isn't about blocking exports, it's about changing the terms. The goal is to move from being price takers in a global commodity market to price setters in a controlled one. For consumers, this matters most at the lower end of the EV market. A $35,000 electric vehicle is far more sensitive to a $3,000 battery cost increase than a $90,000 luxury model. Budget EV manufacturers were already operating on thin margins. Some will absorb costs temporarily. Others will raise prices or delay launches. We're already seeing evidence of both. The medium-term outlook depends on variables we can't yet measure: whether other lithium producers increase output, whether battery technology shifts away from lithium dependence, or when and whether the Santiago Declaration holds under economic and political pressure. The formation of a lithium cartel reshapes the economics of the energy transition. For years, the assumption was that EV costs would continue falling as production scaled. That assumption now faces a structural challenge. What happens next is genuinely uncertain. Resource cartels have mixed track records. Markets adapt, alternatives emerge, and political alignments shift. But as of February 2026, the rules of the lithium market have changed, and the effects are already being measured in both battery costs and vehicle prices.